What's going on, guys? It is the Zoomer Value Investor here to talk to you today about two really interesting articles from CNBC that you really need to know about, essentially because of the statistics and the sheer reality that it's going to present. Looking at this first article and this first headline here, you're talking about the wealthiest 10% of Americans now own a record 89% of U.S. stocks. This came out October 18th of 2021. By this point, I'm really surprised if that number is not 90% or above. Doesn't that seem like a polarizing inequality and a polarizing wealth gap? Well, that's because it is. Stocks are an asset. They're something that can create value. The wealthy have been accumulating and accumulating them over the years. What about the other 90% of Americans that we're not talking about who don't own this 89% pool of stocks? How are they doing? Well, amongst that 90%, you're talking about 63% of Americans are now declaring that they're living paycheck to paycheck. This is a much more recent article. This came out October 24th, 2022. The other thing I find really fascinating about this article is that for the earners above $100,000 or more, about half of them declared that they're just barely getting by. So why is that? Why is that so many people feel like they're struggling to make ends meet? Why is it that only the small 10% pool seem to hold all the assets of the world? Meanwhile, the other 90% of the world barely hold any at all? Well, that's some topics we're going to explore here today. As you may or may not know, the United States Federal Reserve, as well as a lot of other central banks in the world, use a form of currency called fiat currency. This means that essentially it's up to that central bank whenever they want to start distributing and printing currency. This can lead to what is known as inflation or devaluation of the already other out there in the world existing currency. In the Richard Nixon era, the United States chose to switch from the gold standard, which meant that the United States dollar were represented by an accounted for stored fortune of gold, for instead the fiat system. The United States has not looked back since, and the United States has continued to print money. With that being said, how many people around you, how many people maybe at your school, at your job, in your community, how many people feel like they have a good grasp of the economy? How many people could tell you about inflation, tell you why it happens, tell you how to protect against it, tell you what assets to buy, tell you about how as you earn money at that job, you have to invest that into a vehicle that can actually outpace inflation? How many people know that every year that goes by that they're not getting any kind of raise at their job, that they're getting devalued in their income at their job? All, of course, again, because of inflation. Let's talk about ebbs and flows of the economy. How many people could tell you about the bond market? What might happen to the other prices of assets in the market if there's an inverse in the bond yield curve? What I'm trying to say is, I believe to a lot of people, a dollar is just a dollar. They just work, they go about, they love, they make friends, they live their life. It's really important to note here that finance almost purposely exists in the class system, and finance purposely has a lot of convoluted layers on and to of itself. And the reason why these convoluted layers exist, I can't shake the feeling that exists to try to keep out the lower class people, the lower middle class people. It's literal knowledge gap. Purposely kind of shuts them out of what's possible. So I think that's why it's really important to learn basic stock market knowledge, market knowledge. You have to know how the bond market works. You have to know about inflation. These kinds of things are important. If you want to build financial independence here in this American capitalism system, these things are integral. Let's say I saved up a heap of money in 2015 and I was like, hey, this is a rainy day fund, this $1,000 or whatever I might have saved up. I saved up $1,000 in 2015. It's my rainy day fund. I just in case something happens in my life, who knows, right? Well, let's say I was fortunate, more or less. I continued to live off other wages. I was glad I had those savings in the back of my mind. I just kind of slept a little better at night knowing I had that extra $1,000 in my pocket. The years pass, 7 years go by. We're in 2022. The thing about that $1,000 I put away in 2015, that's just not going to buy me as much. And since 2015, there was a cumulative rate of 25.2% inflation over the course of those 7 years. That's a little bit over 3% per year, and inflation is normally closer to 2% per year. That means in the last recent years, there's been a lot of money printing going on. What that also means is I take out that $1,000 for my savings because I suddenly need it for stuff. But here in 2022, to buy what I thought would only cost $1,000, I actually need $1,250. And the reason for that is because the people who own the items I wanted to buy at maybe the warehouse stores, maybe all the other stores, the Home Depot. What they've done is they've went ahead and fixed their prices to keep pace with inflation. So now I'm over here, thought my $1,000 was sufficient for the emergency project all of a sudden that's come up that I need to tackle. But here in 2022, I actually need $1,250 to do all that I wanted to do, to buy those things I wanted to buy. And again, this is because we live in a fiat currency system where our Federal Reserve has devalued by printing money. There's more dollars in circulation. Now your dollar that you held in the savings is less valuable as a result. What do we do about inflation? What do we do about this thing that's devaluing our savings? That's really scary. All the money printing is going to come and take our money. Well, here at the Zoomer Value Investor channel, we like to invest our capital in assets that we believe can grow compounded over time and outpace inflation. And again, in value investing especially, a lot of that is about investing $1 into an asset that is producing more than the dollar. You're investing into a business that to you is worth $1, but it's only priced at 50 cents. That's what the margin of safety is. That's why value investors like Warren Buffett, Ben Graham, why they've had such successful careers. They've stuck to this process that's given them a margin of safety, puts the understanding behind the process of why they are putting their money where they are and why it should compound for them over time and why it should be protected to the downside, because a lot of the downside is already priced in at the time of where they're buying the business. The other really successful strategy you can do that I like to do myself is indexing the S&P 500, the S&P 500 being, of course, the 500 biggest companies in the American economy at any given time. Owning this index is a simple bet. It's betting that the overall American economy is going to grow. You're not placing any bet on any individual business. It is a very safe, reassured, diversified over 500 major companies kind of bet. So let's say in 2015, when we had those $1,000 in saving, let's say we put it into an S&P 500 index fund that was returning more or less at 8% a year. Don't get too hung up on that 8% number. Remember, stocks go up and they go down. Maybe one year it goes up 16%, the next year it's going down 8%. It all more or less might balance out close to 8%. We might see 6%. Who knows? For all we know, stocks could be in what's called a lost decade for the next 10 years, where at one point and then 10 years passes, stocks are valued at the same equal point. If you look at the economy of Japan, they are still actively working to get back to a high that their index hit in the 1980s. That's why there's a lot of risks involved with stocks. Not a lot of people want to put their money somewhere and then go over there when they need it, and their money is devalued. Stocks are volatile. But volatility is the price you pay for outperformance of inflation in the long run. So as you can see here on this model, with our $1,000, let's say we got more or less kind of lucky, but things followed our plan. We get the 8% compounded rate. Boom. 2022 from 2015, $1,000 investment. We now have $1,700. Having $1,700 to go and buy that stuff at Home Depot in that emergency that costs $1,250. It's so much better with $1,700 than it is with $1,000 trying to buy that stuff in that emergency. And the thing about the stock market is that a lot of people get hung up on that risk. But it is real. When you do put money in the stock market, you go in with a plan and you say, I might not see this money for a few years. A lot of expletive crap could happen. And this is something Peter Lynch really hashes out on. People get traumatized. People lived through the Great Depression of the 1920s. They were all in the market at some point. Maybe they got greedy, started getting greedy and making greedy calls towards the top. They lived through the 1920s, and then these people have kids and then they go, oh man, I do not like that stock market thing. I do not like that stock market thing. So even though that kid might have big dreams for maybe, rising out of their current socioeconomic class, really making a name for themselves, maybe even on Wall Street or something of that nature, because they have this parent who was involved in something like the Great Depression, that kind of culture, that sentiment really lingers. It lingers because those people were hurt. They were traumatized. In this cycle, it happens over and over again where people don't have concrete plans. They get invested in these assets, and when these assets blow up in the market, it's just a bad bad period of their life. It's a bad period of their life because they didn't have that overall plan. And this cycle, it keeps happening over and over. Not only the 1920s, happened in 1982, happened in the dot-com bubble, happened in 2008. These things happen. So my question is, how many people around you believe in the stock? Actually believe that they could become one of these 10% of Americans who hold 89% of the stocks, and they are declared they themselves. You, Mr. or Mrs. or Miss, are one of the top 10% wealthiest. So that's something I just really want you to take home and think about here today. Thank you so much for watching this video. But the end message is really just think about how much of finance really is just convoluted and complex layers that exist solely to just kind of make there just inherently exist a educational and knowledge gap structure that does divide society between rich and poor.